What if the biggest threat to your money isn't the future, but history repeating itself? The global economy hasn't collapsed once or twice. It's collapsed again and again, each time wearing a different mask. Before we break it down, like this video, share it with someone who cares about investing, and subscribe to Mano Invest. This channel exists for one reason: to help you avoid mistakes the world keeps making. In this video, we're rewinding the clock. We'll uncover the economic disasters that reshaped markets, destroyed fortunes, and quietly rewrote the rules of money. And if you watch till the end, you'll see the patterns most investors miss, but the smart ones prepare for. Let's begin. 1. The Great Depression, 1929 to 1939. By the late 1920s, America believed it had cracked the code to eternal prosperity. The stock market had surged nearly 400% during the decade, powered by optimism, innovation, and something far more dangerous: debt. Investors didn't need cash to buy stocks. They used margin, borrowing up to 90% of the purchase price, convinced prices would keep rising forever. On October 29, 1929, that belief shattered. In a single day, the market collapsed under its own weight. By 1932, the Dow Jones had lost almost 89% of its value from its peak. Wealth didn't just decline, it evaporated. Banks were next. Over 9,000 U.S. banks failed during the 1930s, wiping out life savings overnight. With no deposit insurance, panic spread fast. Businesses lost access to credit. Factories shut down. By 1933, unemployment reached 25%, meaning 1 in 4 workers had no job. The human cost was staggering. Bread lines wrapped around city blocks. Farmers lost their land as crop prices collapsed by more than 60%. In the Midwest, drought turned farmland into dust, forcing mass migration. The economy didn't recover quickly. Even bold government intervention couldn't restore confidence overnight. It took a full decade and ultimately global war to revive industrial production and employment. The Great Depression taught markets a brutal lesson. When leverage, speculation, and weak regulation collide, the fallout can last a generation. 2. The 1973 oil crisis. In 1973, the world discovered that economic power could flow from beneath the ground. Following geopolitical tensions in the Middle East, the Organization of Arab Petroleum Exporting Countries imposed an oil embargo on several Western nations. Oil supply tightened almost instantly. Prices didn't creep up, they exploded. Crude oil jumped from $3 per barrel to nearly $12, a fourfold increase in months. Energy-dependent economies were blindsided. Gas stations ran out of fuel. Long lines became a daily reality. Governments introduced rationing and speed limits to conserve energy. The shock rippled everywhere. Transportation costs surged. Manufacturing slowed. Food prices rose. Inflation soared into double digits while economic growth stalled. The global economy entered a rare and painful condition: stagflation, where high inflation and high unemployment exist at the same time. Traditional economic tools failed. The crisis exposed a dangerous truth: modern economies were structurally dependent on cheap energy. Oil-producing nations now held enormous leverage over global markets. The response reshaped policy for decades. Countries invested in fuel efficiency, strategic petroleum reserves, and alternative energy. The oil crisis didn't just disrupt markets. It redefined economic vulnerability in the modern world. 3. The 2008 global financial crisis. The crisis of 2008 began quietly, inside American homes. In the early 2000s, easy credit fueled a housing boom. Mortgages were issued to borrowers with weak credit histories, adjustable rates, and little income verification. Rising home prices masked the risk. Wall Street transformed these risky loans into financial products, packaging them into mortgage-backed securities and selling them globally. Credit rating agencies stamped many of them as safe. For a while, the machine worked. Then housing prices peaked in 2006. As prices fell, homeowners found themselves underwater, owing more than their homes were worth. Defaults surged. The financial system began to crack. In September 2008, Lehman Brothers collapsed, triggering panic across global markets. Credit froze. Banks stopped lending. Trust vanished. Stock markets plunged. The S&P 500 fell more than 50% from peak to trough. Global wealth losses reached into the tens of trillions of dollars. Governments stepped in with massive bailouts. The U.S. launched a $700 billion rescue program. Central banks cut interest rates to near zero. But the damage was already done. Millions lost homes. Unemployment surged worldwide. The crisis exposed deep flaws in financial oversight, risk management, and incentives. It proved that when finance becomes detached from reality, the collapse doesn't stay on Wall Street. It spreads everywhere. 4. The COVID-19 market crash, 2020. At the start of 2020, markets were calm, confident, and priced for perfection. Then the world shut down. As COVID-19 spread globally, governments halted travel, closed businesses, and froze economic activity almost overnight. Fear hit markets faster than any crisis before it. In March 2020, the Dow Jones Industrial Average suffered its 3 worst point drops in history within days. The S&P 500 fell over 34% in just 33 days, the fastest descent into a bear market ever recorded. Liquidity vanished. Investors rushed to cash. Even U.S. Treasury markets showed signs of stress. Then came the response. Central banks unleashed unlimited stimulus. Interest rates dropped to zero. Governments approved multi-trillion-dollar rescue packages. The U.S. alone injected over $2 trillion directly into the economy. Something unprecedented followed. Markets rebounded before the economy did. By August 2020, the S&P 500 had recovered all its losses, marking the shortest bear market in history. But beneath the recovery, small businesses collapsed, unemployment spiked, and inequality widened. Financial markets surged while much of the real economy struggled. The COVID crash proved how powerful intervention can be and how disconnected markets can become from everyday economic reality. Finally, history sends the same message again and again. Crashes arrive suddenly. Confidence disappears fast. Recovery takes time. And once stability returns, the lessons fade. The real question isn't if another collapse will come. It's when, and whether you'll be ready. If you want to understand markets, avoid repeating history's mistakes, and learn how to think like a long-term investor, subscribe to Mano Invest. We don't chase hype. We study reality. See you in the next video.